I'm very pleased to welcome all of you. I'm the Director of Impact Investments for the John D. and Catherine T. MacArthur Foundation, headquartered here in Chicago. And it is a huge pleasure to co-host this event with our fantastic partners, the Kellogg School, of which I'm a proud alum. Where are our Kellogg students? Are you in the house? Are you here? Thank you for coming from Evanston. And also Chicago Booth Social Enterprise Initiative, which is another great program. And where are the Chicago Booth students that came and joined us? Oh, Hyde Park, very strong. And since I grew up in Hyde Park, you know, I feel a little torn here. So part of the reason we wanted to host this event is because Cathy Clark is one of the most important people out there writing, talking, and sharing ideas about impact investing anywhere in the country and around the world. And in fact, if there's a meeting on impact investing, Cathy will be there. It's fantastic. And it was just so fortunate because she's doing a project with us at the MacArthur Foundation. She's co-authored this book with Ben Thornley and Jed Emerson, who's another thought leader in this field. And we thought, as long as we were going to fly Cathy and Ben to Chicago in February, we might as well be nice and share them with everybody else in town. The other reason we wanted to do this is because I'm not sure that folks that live right here in Chicago who are interested in impact investing know all that much about what we've been doing at MacArthur, and it's actually been going on for 30 years. So how many of you in this room right now work for an organization that currently or has ever received an impact investment from the MacArthur Foundation? Can you stand up? Program-related investments. More than you knew. Thank you very much. And many of you have paid back those impact investments too, and we thank you for that as well. And you've leveraged them, and you've used them to create more affordable housing, to finance small businesses, entrepreneurs, child care centers, health clinics. There's a whole bunch of great stuff going on in Chicago all the time, and we're incredibly proud that we get to use our resources in this way. And in fact, right this minute, we have $50 million invested in impact investments working here to make Chicago a stronger, better, more vibrant community with more opportunity for more people. So with that, I want to just say a couple words about Cathy and turn it over to her. We were trying to figure out when we met. It's at this point a distant time. It's certainly before the word impact investing was used, because that's actually a pretty new term. Cathy was one of the first people I ever heard talk really seriously about the challenge of measuring social impact. Something, measurements and metrics are something we hear about all the time, but I think that was 15 maybe years ago that we were starting to have that conversation. Certainly when I started working in this intersection of finance and social good, there wasn't even the term social enterprise. So it is just an amazing thing to me to see this many people recognize that when someone like Cathy's coming to town, it's important to show up, snow or no snow. So Cathy leads an incredible center at Duke. She's got all kinds of students working with her. She was a member of the National Advisory Board on Impact Investing that issued a great report last year called Private Capital for Public Good. I don't know if you can see her Twitter handle, but I've learned that Cathy HC is where you go on Twitter if you want to make friends and learn about all things impact investing. How she does all of this and writes books at the same time, I have no idea. She also has 2 kids. So with that, I'm just going to say that I'm very happy to not only have the job that I have, but to have a job that lets me get to work with people like Cathy.
Oh, you're so kind, Debra. Thank you. It's an honor to be here. It's great to see all the interest that there is in Chicago, 20 inches or not, in impact investing. The secret to writing a book while doing all the other things I do is to have co-authors. And I have wonderful co-authors, and they are quite regretful that they couldn't join me here today. So I wanted to, first and foremost, thank both Ben and Jed, because we really enjoy working together, and we have different perspectives. So later when we get into the Q&A, I'm going to try to channel what Jed would say or what Ben would say, so you get the full breadth of the reactions. What I'm going to do now is actually walk through a bit of a presentation that talks about the book that we just released in October called The Impact Investor, but more importantly, the research that that book was based on. Try to do it pretty simply so that you can get the contours of what we found. And then we're going to have a little bit of Q&A, first between Debra and me, and then with the whole room. And I really look forward to that because the field of impact investing is really at its infancy. And as Debra mentioned, the term itself is rather new. The practice of doing it is not new at all, but the attention that's been given by so many different sectors in society to thinking about how impact investing can be a tool for them is dramatically new, and it's a really exciting time. And so when Jed, Ben, and I started thinking about doing some research in this field about 3.5 years ago, the first question we asked, and it relates to what Debra was talking about impact assessment, the first question we asked was, is it time to start telling the story of performance for impact investing funds, right? So everyone thinks about, I'm an entrepreneur and I want to get some money, but what, who are you getting it from and how are they doing? And what are the pressures for them? And so that's the research question that we actually started with. And we set out to look across the universe of different institutions, and there's clearly a very long history of people who have been doing microfinance around the world and people who have been doing community development. But what could we see across different sectors to kind of show the diversity of this field? So the first thing we did is we said, well, who has performed? And so to answer that question, we went out and we identified about 350 impact investing funds around the world. And we went to the people that invest in them, which tend to be LPs or limited partners, although there's different forms and different kinds of stakeholders. And we said, who's great? And then we defined that. Not just who you think is cool, but because there's a lot of that, a lot of hype in the marketplace, but who has actually met or exceeded your expectations, both in financial return and in social impact. And that list got much smaller. About 30 funds were named consistently, or at least by one or two people. And then we went to those 30 funds and we started digging around and talking to them. And we said, well, there's some here that are kind of on the edge of being successful. They don't really have exits, or they haven't really paid the money back. There's some here that are really great, but they're all kind of doing the same thing. Let's just assemble a group that's diverse and interesting. So get the idea of statistically valid sample out of your heads. That's not what this was. What we said was, let's choose 12. Let's choose 12 funds around the world that are meeting or exceeding their investors' expectations, and let's look at them deeply. So we spent 3 years. We actually went under the hood of these funds. We signed non-disclosure agreements with them. We looked at their records, their agreements, their investments. We did 360-degree evaluations. We did interviews with all of their stakeholders, their investors, their entrepreneurs, their partners. And our question all the time was, what's your special sauce? What has led you to have this success? And then we look for patterns across the funds. So what I'm going to tell you about is a little bit about the 12 funds. I'm going to tell you a little bit about the patterns and then some implications of that. So the 12 funds themselves manage about $1.3 billion. So it's a very small percentage of even the impact investing marketplace right now, which the Global Impact Investing Network estimates to be about $44 billion. In terms of the kinds of impact that they target, it's quite diverse. As you can see from here, we have across this portfolio of 12, many of them are working in business growth and job creation, health, microfinance, education, agriculture, and affordable housing. In terms of their financial performance, and this is something that I want you to really remember, it's really diverse. And what we found is, and we kind of divided the financial achievement of these funds into 3 categories, and I'll just read you the labels and then talk about them. So the first one is looking at emerging and developing market, equity, hybrid, and debt funds, and those returns range from 3 to 22%, so quite a big range. Developed market funds between 10 and 14%, and then a set of funds that we call social debt funds that were going between 0 and 3%. So here's the thing to remember about this. This was the funds that succeeded. This was the funds that actually met their target. So that range between 3 and 22% isn't that the 3% funds didn't do what they intended to do, that's what they set as their goal. So there's a huge variety of goals in this space. especially outside of the developed markets. We also talked to them a little bit about the kinds of impacts that they have, and this is just to give you a few aggregate figures. They had so many different impacts that one could not aggregate, but of the ones we could, 1.3 million jobs created or sustained, 17 million people provided with access to finance, 40% of the enterprises receiving finance were led by women, and 60% of the enterprises receiving finance were led by individuals from disadvantaged groups. So some impressive figures. The 12 funds themselves, you'll see, are also quite diverse. Some of them are equity funds, some of them are debt funds, some of them are community development funds, some of them are banks, some of them are private foundations. They're all kind of different forms, which makes them somewhat interesting and shows the diversity of the marketplace. However, when you look at the country of origin of where they're based and where many of their assets come from, they are heavily weighted toward North America. And there's a reason for this, and I want to emphasize this. The reason is we're looking at funds, by focusing on performance, we're looking at funds that have been around for a while, right? There's no fund in this group that's less than 5 years old. Because if you're less than 5 years old, you probably haven't returned all the capital. So we're in a sense, we're focusing a lens on what was true of the marketplace about 10, 15, 20 years ago, and trying to make sense of what that implies for today. The other thing that we looked at was we started to look at how to understand the terrain of these funds in terms of what they were actually trying to accomplish. And I wanted to show you this chart that we ended up doing in our landscaping around kind of where their money comes from, kind of money in, which we call their investor base, and where their money goes to in terms of money out. And what we noticed is that there was a pretty clear dichotomy in the money in from when people were getting their money from government or being propelled by government, and when they were getting it from kind of private interests. And on the bottom, the y-axis or the x-axis, a really big differentiation between when they were, we called it blueprint to scale, which is taking it from a recent Monitor report of looking at when they were doing early stage investment and when they were really trying to bring something to scale. And when you map that out across the four funds, what you end up with is these four different roles. And we started to see patterns among the people that were in these different quadrants that we think were really interesting. So for example, the first responders are often funds that receive some sort of subsidy, that are not going to be able to sustain themselves without that. And a really good example is Axion Texas, which has just renamed itself and made our book obsolete a month later. I think it's Lyft US, is that what it is? I don't know if you guys have seen that. But they are a nonprofit fund that does microloans to enterprises around the Southeast. It's very expensive to do a lot of small loans. And so they have, they're a community development finance institution. They have funders who care about what they're doing, but they're subsidized and they don't earn all their income. And but they have, you know, they are always going to kind of be needed in that role. We also have on the upper right solution specialists, which are funds that were created by and with government to start to address particular solutions in the marketplace. And an example of this fund is a fund that we profiled that the CEF program runs, the CEF Sichuan Fund, where the government of China went to CEF and said, we would really like to take what you do in other places and bring it here and do job creation and development. And so they brought them there, and they're specifically worked to do that. In the lower left, we have what we call the early stage innovators, which is a lot of private sector money. You see a lot of angels in here where there's someone with some sort of social bent and intent and they start investing in early things and they're ready to take risks. And you see it at the fund level as well. And then the last one is scale agents, where it is no longer required for government to be a part of the motivation for that fund, but they're starting to get things to scale. And when we looked across, we realized that there are patterns within each of these quadrants around how they account for impact and how they think about the best way to work with their stakeholders. Another part of the book that we spent a bit of time on, which was really interesting, was really saying, how does impact investing function in the larger capital marketplace? And we noticed, and I'm just going to kind of build this pyramid real quick. What our analogy in the book is that impact investing is in some ways the tip of a much larger iceberg. And that iceberg that we have here is, you have impact investing and social enterprise at the top, which are, have emerged, as Debra pointed out. The terms didn't even exist, social enterprise, 15 years ago, but in the marketplace have emerged around kind of common concepts, which we called outcomes-driven concepts. So people who are trying to push towards outcomes, and the key practices of that are intentionality about what those outcomes are, accountability to measuring them, and a really important one, which is constituent alignment, which is looking at the different stakeholders that have a part in that outcome and working to understand what their interests are. And then we said there's an underlying part of the market that's actually much larger in the financial community, which is about mitigating risk. And when you think about a lot of the conversations that have gone on in the socially responsible investing movement, the CSR movement, and even some of the ESG kind of screening that people do, it's been around, can we identify future risks and mitigate those? And that's been some of the impetus. And what we are saying in the book is that we think that some of the practices of the top of the iceberg are kind of flowing down into the larger financial marketplace, and that has interesting implications. So get to the main message here. What is actually different about impact investing when we looked across the practices of these funds? So 4 big differences. The first one we call DNA, which is these funds from the outset build their mission into the DNA of what they are trying to do. They create an investment thesis that has that mission intact. They convince their stakeholders that they, above other people, have some competitive advantage in reaching that mission, and then they account for that along the way. We call that mission first and last. We actually thought, one of our hypotheses going in was that there would be funds that were really financially centric, and there would be funds that were really impact centric, and there wouldn't be anybody in between. But when we talked to them, they all did the same thing. They all said, no, we build it in from the beginning. It is part of what we do. If 5 years later, that's unclear, we're probably failing. Like these funds, it's completely clear from the beginning what their impact thesis is, and whether it's working or not. And if it's not, they can adjust. The second one is that they have different stakeholders. We were really surprised to find that 8 out of these 12 funds were started by or with government. That there's this, kind of aura of the private sector jumping into impact, but there's a really important role for policymakers in this, and a really important role for the impact investing funds in understanding policy, which leads to the third one, which is we saw a very sophisticated blending of those stakeholders into relationships with the fund. And we call that in the book catalytic capital. We see layers of capital being created either at the fund level or at the deal level, where different people come in with different interests. And it's much more varied than just what's your return, right? What's your strategic interest? What's your impact interest? How do we slot you into the right place for that and diversify that among different people so the whole thing ends up being more powerful? And then the kind of the kicker for all of this is that to do this work, where you're blending stakeholders' interests, turning it into kind of financial roles, and building impact theses that make sense to people, is you need new skills to do it. And so what we also found is among the teams of these successful impact investment funds, every single team had a mix of backgrounds of people who had been in the nonprofit, the financial, and the government sectors. It wasn't always within one person, but within the teams. And as a result of that, they had vocabulary, they had frameworks, they had networks, and they were really, really flexible and able to respond to whatever stakeholder they were sitting across the table with. So just to sum it up real quick, successful impact investing is a multi-sector exercise, especially for these fund intermediaries. It's very stakeholder driven, which is not the way we think about finance so much. They are inventing the right vehicle for the job. I could talk more about some of the very innovative things that they have done to match their interests. They're integrating this idea of cultural change within their very own organizations, because those teams with those different backgrounds, they don't always come in with the same norms about how to work. And many of the fund managers talk to us about that. And then the other one, and I include this for my students, and since we have students here, I wanted to include it as well, which is no matter what your background, there's room for you in this field from wherever you come from in terms of thinking about how you can help impact funds and impact investments succeed. I think I'm actually going to wrap it up there. I wanted to not make this too long, and I'm stuck on my slides. Yeah. Okay.
Sure. So I'm going to ask Cathy to go back to the pyramid slide, because how many people in here don't know what ESG is? And you can be honest. Okay. So I have a hunch, just from my travels. So how many people do know what ESG is? Okay, so a lot of you might be asked to come up here and explain ESG in a second. But I think what I want to do to sort of level the conversation, level set this, is because I thought there was a lot of really important stuff, and that's a fantastic image that I will now copyright and share. Can you just back up for folks who may not know what all the layers of the pyramid are? And I thought it'd be great to do a little definition of that.
Sure.
And then if we could jump from that to the last slide and maybe have you unpack some of the things that are on that slide.
Okay.
Because I think we're good on time.
You're good on time? Okay. I was trying to make sure we... Not yet? All right. So, impact investing. The definition that we were working with is the definition of the GIN, the Global Impact Investing Network, which is investing for the dual purpose of achieving some sort of financial return, anything over zero counts, and meeting some sort of social goal. Social enterprise is the, kind of entrepreneurial equivalent to that, which is what you invest in. If you're doing a direct investment, you're investing in a nonprofit or a for-profit. Although, obviously, people who are doing investing, they're fund of funds. There's, many other layers of things. You can invest in a fund, that invest in a fund, that invest in an enterprise. When we did this study, we actually only looked at people who had some form of direct investment as part of their portfolio. Direct investment meaning investing directly into a company, as opposed to only investing in a fund. On the bottom half of the slide, the acronym that I use, ESG, has become kind of the norm within the public markets, where people are trying to differentiate kind of good things to invest in and bad things to invest in. And the ESG actually stands for environmental, social, and governance factors. And there have arisen over the past 20 years a kind of common set of understandings of what are the environmental factors that we should look at when we're trying to decide whether a public company is doing a good job from a responsibility point of view. What are the social factors, how are they treating their workers, and so on. And what are the governance factors that we think are related to success. And in the SRI, the socially responsible investing field, yet another acronym, there are people in the marketplace who say, we're going to screen out and not let you invest, if we're a fund that screens, the stuff that doesn't do well on these factors. Because we actually think it's a risk. Because if they're not governing themselves well, or they're not paying attention to environmental problems, they could end up like Exxon with a big fine on them, right? So there's this kind of belief that if we follow these factors, it will eventually, it started out as kind of a moral thing, and now it's become actually the norm within many, many environments. And we actually talk about that in the book. We talk about some of the conversations that have gone on within pension funds in the US, which are some of the largest holders of capital, about how important it is to make sure that they are screening for environmental sustainability factors. The last layer here is, again, kind of the company equivalent of the first one, CSR and sustainability, which CSR, for those of you who don't know, is corporate social responsibility, which is basically saying what are the things that companies are doing themselves to be socially responsible, and sustainability being another definition around looking after the environment. Most public companies are now reporting every year on how they're handling these factors because the investors are demanding it of them. How's that, Debra?
That was pretty good. Before I have you go to the last slide, though, so just because we do have Cathy here and she does teach a class, what's the class you teach it to?
I teach two classes. I teach a social entrepreneurship class and an impact investing class.
So there you go. So the professor is here. She's in, and we won't call on Linda and some of the other professors I know are here in the house. Does anyone have, if you have a question of the definitional stuff, because truly we want this to be a conversation for anyone at all? Yes? One of the companies, the funds.
Yes.
You didn't understand, how could Kellogg Foundation be one of the funds? So I want to back up. So we're going to back up for a second, because I have a couple of like giant questions to ask about impact investing, but I want to make sure some of the deep content here. So when we say a fund, you looked at 12 funds. I want you even to say, what was a fund? What is a fund?
Right. So we fudged the definition of a fund a little bit for the Kellogg Foundation, I will admit.
There we
go.
Good question.
So it was a good question. So the Kellogg Foundation, like most private foundations, has an endowment, right, which is a big pot of money that it manages, and it tries to make money on that money so that it continues to do the second thing which it does, which is it takes a piece of that money and it puts it into grant making, right? So that's every private foundation with an endowment works that way. What Kellogg Foundation also did was they took a piece of that endowment and they separated it out into a different pot, and they put a different board around it. And they said, we're going to take this money and invest it for our mission purposes, but we also want it to meet our financial return objectives. So for that action of taking it out and separating it out and managing it as if it were a separate fund, we decided to include them too.
And Kellogg has, they call it the Mission-Driven Investment Fund, and they have actually a bunch of information about it on their website.
And we have a case study that we wrote all about it. If you go to Impact Investing 2.0, it's there.
Other definitional questions? But the idea of a fund means a group of people get together and they say, we're going to raise a bunch of money, and then when we have that money, we're going to go out and find companies. Can a company be a nonprofit?
If you are investing debt, you can give a loan to a nonprofit, and the nonprofit can.
So some of these funds were financing.
Yes.
So when you use company, it includes
nonprofits.
So to a theme that I taught a class called The Business of Nonprofits. So I like to say nonprofits are businesses too. And there are a lot of people I know in this room that, Trinita's nodding her head. So I think the key point is the diversity includes a whole bunch of different kinds of funds, but it's the idea of a pot of money that gets set aside for the purposes of then doing that intentional investing, whether you're providing loans or making equity investments.
And every fund, as I was talking about, kind of this relationship between the fund and its stakeholders, every fund has to convince someone who is investing in it in what they're going to get back, right? So the successful funds are the funds that meet those objectives, and sometimes they don't know whether they're going to meet them, right? So that's why, part of the kind of realm of investing is that there's actually quite a bit of failure, where people start out thinking something is going to work, and then it turns out it doesn't work. And that's okay. But what we were trying to do is we're kind of taking a page from, I don't know how many of you have read Dan Heath's Switch. Dan is, has anybody read that book? Anybody heard of it? One or two? Dan is actually a fellow at our center, and what he talks about is if you're trying to create change in any community, look for the outliers and see what they're doing. And so that's kind of what we did here. Look for the outliers and see if we can replicate what they're doing.
Any other questions that are just basic clarification, right?
Hi, in your definition of fund and in the capital that you talked about being deployed, how does that include the portfolio maintenance function?
What do you mean by portfolio maintenance?
Technical assistance, reporting, it's a whole, et cetera, that falls into that.
Yes.
So is that included?
It does. It includes everything that these funds do to operate and everything that they must pay for to operate.
So your question was, does that return, those 3 bars that we saw?
Right.
Include net of all the expenses?
It is net of
expenses.
Yes. It is returned to investors net of expenses.
Okay. Yes.
Why, like, the bottom 30% don't succeed?
I can tell you stories, and I'm happy to.
I want to clarify the question. Were you asking if that bar on that one side that showed the really low rate of return failed?
Right. So it's not that they didn't succeed, it's that they had a different goal.
I want you to say that really slow. I want to go back to that slide.
So we'll go back to that slide, and I want to tell a story about that, so maybe we want to
So
sit
you were
down.
looking at that slide, and you saw 0 to 3%.
And you thought, These are only funds that have succeeded.
These are the success
So
funds.
when you look at that 0 to 3%, what you want to ask is, why did somebody target 0%? That's what you want to ask.
So he's asking about things that
Gotcha.
aren't on the slide.
Okay.
Gotcha.
So we did a lot of interviews of funds that didn't succeed. We didn't write case studies on them, and we didn't name them in the report. They were pretty much the absolute opposite of what we call the factors, right? So it's actually in there. I do want to talk about the 0% though, because I love this story. The 0% fund is actually not 0%, it's 0.25%. And the fund that is returning 0.25% to its investors is a fund in California called the RSF Social Finance Fund. You guys ever heard of it? Anyone heard of it? Okay. So they're a $100 million loan fund. They loan to nonprofits and for-profits in 3 areas. I think it's education, agriculture, and environment. And they have this incredible transparency practice, transparency being one of these kind of core elements that we talk about as part of collaborative capitalism. What they do is they actually have their borrowers, the people who are getting the loans, and their investors, the people who are putting up the cash, meet every quarter in person and decide what the interest rate should be back to investors. Now, you think about this is crazy, right? Because there's a conflict. There's only 3 places your money can go once you've invested in a fund. It can go to the borrower, it can go back to you, or RSF can keep it to run their fund and do portfolio maintenance, right? Those 3 stakeholders meet every quarter and decide where it goes. And the last time they met, or when they met right before we wrote our case study, they said, the recession has been really hard on these entrepreneurs, and we actually want them to keep the money right now. Amazing, right? An amazing innovation.
I have questions for Cathy, and I know we're supposed to sit in these 2 chairs, but this is working pretty well. So if people have questions, raise your hand. Oh, come on.
I'll just bring up the chairs.
I don't bring that.
We can get rid of
We
the
can go sit
slides.
in the chairs.
Let's go.
Okay, so you can keep thinking of some questions.
What is the difference between investing for 0% return or deciding to make a grant or a donation?
Why would you ever make a loan for 0% and just not make a grant?
I'm a capitalist, and this is about
Okay.
creative capitalism and constructive capitalism, and I want a return on my money. And one of the routes I can do is through socially responsible, or the new buzzword I think is sustainable, renewable investing, SRI, right? And so I've worked in this field, and so one of the things that we did in terms of an issuer that we had was say, hey, you can actually do this, be socially responsible, and get a return. Our particular issuer was not targeting a 0% return for their clients, so for their investors. So can you go down that road a little bit more about why there might be a 0% return, and why the investor might choose to invest rather than, say, working with doing a grant or donation, or working with the MacArthur Foundation, just giving the money to them and having them run with it.
Before I let Cathy answer, I was supposed to make you sit over here. Don't ask why. Very complicated.
I can do that.
Okay. So,
Shall I answer?
you shall answer.
I shall answer. So what's interesting here is there are a set of investors, and RSF's investors, which we talk to, are those investors who said, this is entirely different from giving a grant. I actually do have grants. Many of the people who invest in RSF also actually have another acronym that RSF runs, a DAF, which is a donor advised fund.
So
Another,
if you
right?
got nothing out of tonight,
Right, you'll
you know
learn
you
a few
never want to
acronyms.
know what all these acronyms
So
are.
basically it means that as a philanthropist, you can kind of give your grant to anybody you want directly, or you can kind of stick it into a fund, get the charitable benefit from it on your taxes, and wait to decide who you want to give it to later. So many of those people actually have both. They do charity and they do investment. And what they've said is, I want to be part of a marketplace that supports social entrepreneurs. And what RSF is giving back to them is not just the 0.25%. RSF is giving them the chance to interact with these social entrepreneurs and get to know them and feel like they're part of their success. Turns out that's maybe as valuable as another percent to those people.
I'm going to offer my own perspective. So at MacArthur, we have set aside $300 million. That's what our impact investment allocation is. So the $50 million that's here in Chicago is part of the 300. And we rarely make a 0% loan. We often make 1% loans. And you might ask the same question. Why would you do a 1% loan? Because it doesn't sound like very much. One of the basic reasons is that if something a nonprofit or a for-profit is trying to prove that it's credit-worthy and trying to prove that it can operate successfully and pay back a loan, it can't prove that if you don't give it a loan. Give it a grant, it's actually incredibly valuable to a nonprofit because, in fact, nonprofits, one of the things they can't do is raise equity the way a company can on a stock market. So it's not that a grant isn't valuable, but if you're trying to prove that you're creditworthy, a grant actually is not useful. So we have a saying that we try to take a problem first, tool second approach. And sometimes the problem you're trying to solve needs a grant. If I'm trying to fund Cathy's research, she probably needs a grant.
Not want a loan.
She wants a grant. Most of the where's Ann Evans? You're in the house. Ann Evans runs this fantastic thing called Elevate Energy. And they do all this incredibly hard work to bring energy efficiency to affordable housing and throughout Chicago. Well, a lot of their policy work is not going to make them rich. It doesn't have a revenue stream attached to it, so I'm going to give them a grant. But Trinidad Logue over here from the IFF is making loans that are generating revenue streams so she can use the loan. So I think that's one of the big answers to that. It's not that we're uncharitable.
I wanted to add another point to the RSF because I was reminded of a conversation that we had with one of the RSF borrowers and the lending manager at RSF. And the lending manager, his name is Ted, and Ted is a little bit kind of crotchety kind of guy. And we were at a conference, and he said, honestly, this really gets my goat. I said, what really gets your goat, Ted? He said, the thing that really gets my goat is we give these people loans at really low interest rates, they succeed, and then other people give them loans and make tons of money off of them. But we don't. And he said, but that's okay, because that's who we are. We're there to take the early risk. And the entrepreneur was there going, yeah, and we really value that. Right? So
do you think that's okay?
Do I think it's okay?
Yeah.
I think it's fine. If that's where they want to play, they can play there.
So
what do you think?
I think we need to know what you think over there.
I think that there are funds that decide if they're going to be involved in social investments, right? They make the decision to be or not to be involved in a social investment. And that might be because of their board, it might be because of their investors or shareholders, or it might be because of other exogenous things that are going on around where they want to make a social impact. And so they decide, I'm going to not get a 10% or a 12% rate of return. I'm going to get a 3% or a 2%. Here's a prime example, wind power, right? In many electrical providers give you a wind source option, and you're going to pay more for that. But people like it because they feel like they're doing something different, right? My house is powered by wind power, right? And I pay 5, 10, sometimes 20% more per kilowatt hour to do that, but I feel good about it.
So
I actually do that.
So I think the feel-good piece is a part of it. I think what I'm also hearing is RSF is sometimes saying we're going to be the seed jumpstart part of it.
They're in that early stage lower quadrant
sometimes
because
it's
they
the
want to
demo
be.
part of it.
So following up on that statement, it's about how do I measure the feel good about it. So I think measurement is like key in this sector, right? And I think there are two key drivers in my mind. One is if I am a big institutional investor, or even a small investor, I might want to optimize my portfolio and to say, okay, I have a small financial return, but I have a higher social return, or vice versa, and I can build a portfolio on that. The second is that if I can measure something, that something becomes fungible. So then at a certain point I can sell it. So I can say, I have stocks that produce this X returning, financial return, X social return. I can sell it. I can have an exit strategy. So I guess the question to you is like, what's the state of art in terms of measurement? And maybe besides the traditional sector like energy or environment, where there are like established international protocols and we all know how to measure that, maybe more in the education space or other.
Excellent question. And I honestly wish that I had a different answer. I wish I could say, we have a system that everyone follows and it's all rational and you can buy this much impact and this much financial return and kind of dial up or dial down and order it, stick it to your portfolio and relax. Unfortunately, that's not where we are. It's one of the most important parts of building this field. And what I talk a lot about with my students is what do we need to do to actually have this field have legs beyond this small group of people who are succeeding and the others around in the space is we need to come to a place where there are standards and practices around this. What we found, again, just within this small segment, and I can talk about my other work, for hours, but what we found in this small segment is that there were some funds who talked about their intentions and defined what we call outputs, like measurable things. How many kilowatt hours, did your solar panel save, or how many living wage jobs were created or maintained. And for many of their stakeholders, that is perfectly fine, right? Just show me the extent to which you have done what you have said you're going to do. There are other people in the group that actually said, no, that's not enough. We have to either go deeper and have a third party come in and show that we really made a statistical difference, which is kind of the norm in the nonprofit and government sector when you're trying to show real impact. Or what we really like to have is some third party and come in and do this, could kind of certify us, put a stamp of approval on us that our impact is good enough. And in the book, we lay out examples of funds that have done it in those 3 different ways and how they've done it.
Let me ask if anybody else has questions, because you hear about standards and certification and all of that on this same topic of metrics and certification. Any other questions? People want to know what a B Corp is, and because she's here. So if you want to know what a B Corp is, how many people know what a B Corp is? How about this?
Progress.
How? Would you like Cathy to speak to that question?
Am thinking to become
Okay.
a B corporation because it's an amazing concept, and I think it goes to your governance, it goes to sustainability, it goes to social, and having that holistic view is key. So I think it would be great.
So can you,
to even
for those who
understand it.
don't know, what is a B Corp and why would it matter?
Okay, so Elsie,
And
yes, we
we're-
can talk about
Now,
this
how
too.
many? I think we have 15 minutes. So we will. I'm getting that there's some more.
It can be
topics.
work.
We're gonna,
All right,
we're gonna get
all
our,
right.
our trips worth.
Yeah,
I
you
see
are.
Plowed through this.
All right, so B Corporation is a voluntary certification that a company can apply to get that takes, as you were saying, a holistic view of their impacts across different stakeholders. So it basically recognizes that every business has a set of stakeholders: suppliers, workers, community, employees, or I guess I always said workers, right? There's a set of stakeholders, and if you are trying to be a responsible company or an impactful company, we can actually pretty much ask you what you're doing and figure out whether you are trying to be responsive to those different stakeholders. So the idea is that you're a privately owned company. You go online to the bcorporation.net site and you take a survey. I happen to have helped write that survey many years ago, so I'm very proud of all the hands that are in the room. It's progress when you see that in your lifetime. And the survey's a mess, but that's all right. It's getting better. But the idea is you take this survey, and if you get 80 points out of 200, it used to be 40 out of 100, and everyone thought that was failing, so we just doubled it. Because it turns out you can't do all of these things. No one in their right mind would be in business if you did all of these things, right? Some of them cost money, some of them don't. But if you do that, then you have the right to apply to become a B Corporation, but you have to do one other thing, and that is really, really important, which is that you actually have to change your governance. You have to get your stakeholders to agree that you are going to take into account the needs of those other stakeholders as much as your fiduciary stakeholders.
Can you be a B Corp in any state?
B Corporation is a certification, a voluntary certification. There's something that people confuse with B corporations called benefit corporations, which is a corporate form that was created by the same group. And that is, you're going into business and you have to decide, are you going to be an LLC or a C Corp or whatever you're going to be, and you can decide to be a benefit corp. And it has a lot of the same demands on you as a certified B corporation, but the state will let you incorporate that way as long as somebody, every year you file a report on what you're actually doing. And the easiest way to file that report is to fill out a B survey and shove it in.
It's not permitted in every state.
It's not permitted in every state, but it's actually permitted in, I think it's up to 30 states, and it includes California, New York, and Delaware is the only one that
And
matters.
before you go to L3Cs, did any of the funds that you looked at tell you that they prioritized investing in B Corps?
They did not. There is one fund, RSF Social Finance, which requires all of their borrowers to take the B Impact survey, and they track the improvement of their score over time as part of their loan.
Yeah, and I would just make as a general observation at this point, I've seen lots of reasons why companies are seeking that designation, but as someone who sort of lives in the world of folks making impact investments, I think, and personally, I think one of the challenges is it doesn't designate nonprofits, and I think there are very business-like nonprofits that could, it creates a little bit of a dichotomy that's a bit false. I don't know of any funds that right now are set up where if you get that status, you're going to necessarily access more capital.
It doesn't have to do with capital.
But it does help investors understand
There are
your
investors.
values.
There are individual investors and some others that we've seen who, say to people, I need you to get a higher score, right? So that does happen sometimes.
So before we take the L3C, and that's also the same thing I'm happy to take, we can take off sidelines. Let's get an idea of some of the other questions in our house. I don't want to ignore that, but I want to know what else is on people's minds.
Hi. First of all, thanks for having this here at 1871. There's actually 2 accelerators here that focus on impact investing. I run the Good Food Business Accelerator, which focuses on sustainable, local, humane, and food, growing very quickly. Lots of entrepreneurs who need technical assistance. Also, there's Impact Engine, which has been here for a longer time, really the pioneer at 1871, working in healthcare and some food and lots of tech to support impact investing. So anyway, we've got questions. Both Impact Engine and us are interested both in broadening the number of people who make impact investments for obvious reasons. Secondly, I think both of us are considering maybe starting a fund or some other vehicle to drive more investments in this area, and for investors who aren't quite as savvy in this area as they might want to be prior to making an investment that they would consider risky, this could be a way for them to move. Do you have any advice for us?
So we have a question about how do you bring more people into the space and particularly into 1871's space. What other questions are here, just so Cathy has a sense of what other people are thinking. Okay, so from the, and that's a little bit of the question over here as well, sort of, you're swimming around, you hear everybody wants to be an impact investor, but how do I go ahead and attach myself to them? How do I get some of their money? Okay, and I just want to see if any of the other questions group to that.
No, I'm interested in for not-for-profit and governmental entities, looking at the exit options that are available to them and how that impacts what people are going to invest in.
So if they're going to make an investment, how will they be able to get out? How do they get out? Questions? Hi, Tasha.
While you're discussing all of that, could you also talk about the dangers that can occur once this impact investment gets so commercialized, as he was saying?
That was going to be my last question. We got that one.
Awesome, okay, great.
That's on this piece of paper. Okay, right there.
I'd be curious to hear a little bit more about the business models that have been successful in paying back these loans. And
so this is kind of the exit. How do you get out? What works?
what do you see that turns out to be predictive of getting out?
Okay. So I'm actually going to sequence these so that we can get there because there's food on the sides and so forth. We may run a few minutes past 7:15, but it sounds like people want to take advantage of our friend Cathy being here. And since
These are tough questions.
I did really feel like I kind of hoodwinked her when I told her yesterday morning, oh, it's just a snowstorm. Don't worry, it's no big deal. All right. So why don't we start with, I want to work our way to folks who want to know how you bring more. If you're an entrepreneur, how do you get more? And then this other question of what about happens when it commercializes. But let's start with this question of, I'm an investor and I'm looking in, I'm government or I'm a foundation or I'm a regular investor. What am I looking for that makes me think, I'm going to do this thing, I'm going to get impact, which sounds really good, but I want my money out. And what am I looking for in terms of a business model? What kind of investment vehicle am I looking for? Is that what the two of you were asking, more or less? Exits? Okay. Yeah?
I'm not sure how to answer it. So, what
are these funds looking for that are really going to give them a good potential for exit? How do they get out?
Yeah, so every fund has, this is the thing, you've seen one fund, right, in some ways. This is part of the difficulty for entrepreneurs in looking across the space. I feel, I'm not even sure how to answer the question, which is why I'm struggling with this, because I feel as if, every investment, if it's a debt investment, getting out is just getting your money, getting your, some cash back that is regular enough for someone to be repaid, and you shake hands and you walk away. But for an equity investment where you're taking a piece of the company, that's where the idea of exit comes in, where you basically have to sell your shares to someone in order for you to walk away with your cash. There's really only a very small subset of options for how someone can exit from.
So from your 12, how many of them were getting their exits because the things they invested in did an IPO?
Almost none.
Almost none. Okay. How many of them got their money back because the thing the fund had invested in got sold to somebody else, like a strategic acquisition?
Most of them.
Most of them. Is that starting to help? Okay, Mary.
Okay, there we go. Made nice and tangible.
Okay.
And there is one fund there that has more exits than any other fund we've ever had, and it's in South Africa.
Just put your phone.
My microphone closer. Yeah. And I wish I could tell you the story of all their exits, but I don't remember. But I do know that they have. I've asked the people. So as part of the project that I do with B Lab, which is the organization that certifies B corporations, we also have a rating system, and we have exit data as part of that database. They are the fund with the highest amount of exits across the entire space right now.
So they have the highest amount of exits, and why do they have the highest number of exits?
Because they're selling to, they're in certain industries that are very hot in South Africa.
Hot industries.
Yep.
It doesn't really go to your business model question, but maybe we can
I think business model is another kind of topic entirely.
Okay.
Because I feel like across all the different sectors that people are working in, even if you take one, so you take like, solar, right? There's a bunch of different business models that some people are finding working and not. And so I feel like it's a much more detailed question than I can generalize.
Let's go to this question, which is on a lot of people's minds. If you're a social entrepreneur,
right?
You're a B Corp, you're an L3C, you're a nonprofit, you're a for-profit, C Corp, it doesn't matter. You've got this duality. You're impact engine. You're helping a bunch of entrepreneurs. And you hear there are all these impact investors, right? Every day, David Brooks, right? How many people got tweeted, Facebooked, or something with that David Brooks article? Raise your hands. Oh, come on. I have received at least 100 copies of that article, which was great. But, when impact investing is in the New York Times, right, you think, well, where are all these people? And Brian Trelstad, who got himself in that article, probably is dancing a jig because he has been going around trying to raise impact investing money for his fund. And it's tough. It's really tough because there's all this talk. Kathy?
So a bunch of ideas there. So one is realizing that this is a very, 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 very small percentage of the larger investment market, and if you need to make an investable proposition that works for impact or non-impact investors.
Say that again. You need to make.
You have to create your company and serve it up in a way that investors see it as investable. Now, what does an investor see as investable? They look for patterns of either cash, so that you're appropriate for debt, or growth, so you're appropriate for equity. That's kind of it. Those are the two categories. Now, there are a lot of, kind of hybrid, weird things in between that sophisticated investors like Debra can make up for certain areas. But for most enterprises, those are the two main categories. And when I work with entrepreneurs, we have an accelerator that we run at Duke. We try very hard to help them see, how can you get your model into a pattern that matches, the needs of a large class of investors. Then you have what we call knockout criteria, and you have alignment criteria. Knockout criteria are industry, size, geography, right? So when I talk to entrepreneurs and I ask them kind of who are you going after for funding, and you tend to look at their lists, usually about half of them you can knock out right away. Don't even bother talking to them, because if you're not in the right stage, you're not in the right geography, or they're doing equity and you're looking for debt, don't even bother. And then there's a smaller set where then you need to say, are we close, and how are we going to make that?
So how many of you in the room are entrepreneurs that have been seeking capital or thinking about raising capital? Fair number of you. Is this issue of yes, the investors are out there, but they're not interested in my issue? How much of that is a problem? Is that a problem that you hear? Because we hear that a lot. People get frustrated with foundations, because we don't have, our issues don't align with what you're doing. So you're saying,
there are starting to be some. So so if you're in a high growth pattern, I'm the chair of the board of a group called Investor Circle. How many people have heard of
Investor Circle.
Okay, quite a few. And that's a national group with local chapters of angel investors, of individual and small fund investors who are interested in doing early stage deals with high growth potential. That the group is grown tremendously. They put $25 million to work in the past 18 months, which for early stage deals is amazing. But if you don't have a high growth pattern with a really exciting exit potential, they're not even going to look at you. In terms of other lists of investors, there's a list on Impact Base, which is only open to accredited investors, which is not helpful at all to entrepreneurs. But if you can find an investor who can kind of do a search for you, you can.
So I have a trick that I suggest to some investors. If you're running a nonprofit or you think you're in the 0 to 3%, so you're looking for a foundation type philanthropic impact investment, there's an organization called Mission Investors Exchange. I apologize, because of the snowstorm, my wonderful colleagues that I work with are all with their children in different houses. We have a resource list we put together. We'll post it at macfound.org. So if you come on our site, hopefully in the next day or two, we'll have it up. Cathy's shop has a fantastic list. But if you go to Mission Investors Exchange, you can see, you have to do a little bit of legwork. You can see a list of all the foundations that belong. It's about 300 that do impact investing. You then have to do a kind of crosswalk through the foundation center because you got to look at which of those foundations overlap with your issue and your geography. But I often will suggest to organizations, start with the funders that you know are interested in your issue and your geography, and you may know that already, and then go see if they're in Mission Investors Exchange, and that will help you understand
And the other
connection.
resource I wanted to mention, there's a site called Enable Impact. I don't know if you guys have come across that. It's pretty new, but many, many impact investors have started listing themselves on that site. And what's nice about it is they've characterized themselves by all the knockout criteria, the geography, program, industry, stage, so that you can pretty quickly get a list, at least to start with, of people that might match you.
Did we get to the ES? You had a question about ESG? Market rate. Let's touch on that quickly.
Yeah, so I tried very hard in that slide that I gave you not to frame this as, you caught that, as market rate or concessionary. And we tried in our whole study to do that. And here's why. If I, the investor, get back what I wanted, who cares if it's market rate or not? And who's to say what's market rate or not, right? So you could go into these funds and you could benchmark them against their closest asset class and decide whether they are market rate for their asset class or not. You can do that with some of them. Actually, a lot of them you can't. I don't know how you would benchmark Calvert Foundation's Community Investment Note. I don't know how you would benchmark the people sitting around a table at RSF and deciding what their interest rate is going to be, right? And we wanted to broaden the conversation rather than narrow it. I hope that doesn't seem as a cop-out answer, but we were really trying very hard to say success is in the eye of the investor, ultimately, not the person slapping a benchmark figure on it.
So the question is, if we don't have more market rate impact investments, are we limiting the flow of capital?
I don't think so. I think it depends what quadrant you're in. So again, adding some texture to this conversation, there are very distinct interests that government has in solving poverty or investing in the developing world, where DFIs are development finance institutions are very, very involved in impact investing. Almost all of the funds there have development finance institution money. Because there are, government interests, not just in the U.S., but in Sweden and Norway and UK and everywhere, of, trying to use money to get these outcomes, to really change in developing countries. That marketplace right now is actually bigger than the market rate marketplace for some of these very high impactful things. So I'm not sure I'm willing to go with unless it's market rate, it won't grow.
And I think that would be a really interesting one to have a couple of people coming, because there's a lot of folks along a spectrum of points of view about that. Because there are folks who believe that I've heard people say, unless you meet or beat what is considered market rate, this whole thing is a waste of time.
And again, it depends which quadrant you're in. That's true in the scaling quadrant. And a lot of people only see the scaling quadrant.
But then you look at things, like affordable housing, where the economics just don't work without a subsidy because the incomes of the people living in the housing, just don't support the cost of operating that business. It's not that it's not a sustainable business model, but there does have to be subsidy. It can support a modest rate of repayment that can be a 1 or 2% loan. It works. So why not use debt and save the grants for the things that grants are really valuable for? And this conversation between, is everything got to be market rate to be successful? And we really live in the middle, and we often see ourselves as being able to play a risk mitigating role. And by absorbing some of the risk or other kinds of issues, we're able to make things market rate, because there are folks that don't just have to worry about what they like. They are subject to regulation.
So the other answer to that, I guess, is the complexity of what we saw when we were talking about catalytic capital and layering, right? So if you have, and one of our funds that we profile in the book is Deutsche Bank's first microfinance fund. They had, I think, 7 layers in that fund. 3 debt, 3 equity. Each one had a lower guarantee layer that was put in by the government, one by USAID, one by DFID, which is the equivalent in the UK. Then they were able to get strategic investors in at different rates. So if you're Coca-Cola and you just thought doing a microfinance deal would be really good for your GRI report, your Global Reporting Initiative report, I know, it's crazy, sorry. You're going to go in, and they were happy to go in at a 3% rate. But your Citibank, or it's not Citibank because it was Deutsche Bank, but some other financial investor, you actually want 7% because that's what your alternative capital is. So the idea is, instead of thinking about market rate as kind of one thing, look how creative people can be. And all of a sudden, they overshot their fund. They raised 125% of the capital they expected to raise because all these people were getting their needs met because other people were in the deal.
I'm not going to take another question, but I want to take that back to the earlier question in the back about how do we bring more folks in. I think one of the things we've experienced is taking that creative approach and sort of creating spaces where different players can come in with those different motivations that they may have. We can make it easier to connect things that I think is very difficult, and the real capital markets don't work like that. If you need a mortgage for your house, you do not go out to 5,000 bondholders and sell each of them a small piece of your house. You work through a value chain, you go through a broker, and the broker gets a loan, and the loan is issued, and the loan is sold, and it's put in. Now I know, talking about that today makes people nervous because a lot of bad things happened, and that's another conversation. But the reality is that is an efficient way to connect lots of people over here who need capital with lots of investors over here who want to deploy it in different sizes, scales, and at different rates of return. And that's part of what's missing. That's the missing middle that we're still building in this space. Because ultimately it cannot be many to many. It's too hard. Everybody is going to die trying. I don't want to ignore the L3C question. Let me ask how many people want to know that, because if you're dying to know it, I will stand over here when we get off the stage, and I will answer that question, but it's pretty wonky. So if you permit me, I'm going to ask the last question, which is kind of a combination. Are you worried about anything? Do you think this is, with the hype, is impact investing going to just get commercialized and watered down and kind of greenwashed? Or do you think there really is a there and feel optimistic?
I am generally an optimistic person, so I'm sure that shades my answer. I'm actually really excited. I'm excited that so many different institutions from the different sectors and so many banks and financial institutions and are stepping into this and mucking around in it. It doesn't mean they're all doing a great job yet, right? That's okay. I'm excited about the potential of the demographic shifts that we're seeing, right? So when you go to Morgan Stanley and you say, why are you doing impact investing? They say, because the millennials are requiring it, and if we don't come up with some things that please them, we think we're going to be out of business in 10 years. So fear is great, right? We love that. What worries me is that until we really set some useful standards for what success is on the impact side, the greenwashing thing is too big a risk. So that's where I come off. Huge opportunity, really big risk that we're letting people slide around too much.
All right, well, I want everybody here to just join me in thanking Cathy and Ben, who is in New York in spirit with us.
Thank you guys.